From the morning reading, financials lead rally. The Q's near all-time high. Netflix up sharply in after hours on earnings per share beat. Breadth strengthened compared to the prior session as advancers led 1616 to 1379 on the New York Stock Exchange and led 1577 to 1220 on the Nasdaq. On the S&P 500 snapshot, a modest gain on light volume. The S&P 500 hit its negative 0.20% intraday low 5 minutes into the session and then recovered to a narrow trading range around the flat line through most of the session. A small rally in the final 30 minutes lifted the index to its modest closing gain of 0.18%, putting it only 0.22% below the record close of January the 6th. Wall Street doesn't want to be left behind. Analysts have been busy raising the price targets of companies they follow. Over the past 2 weeks, there have been an extreme number of increased price targets versus decreased ones. This is despite few companies having reported earnings. Unlike most other times, analysts rapidly raised a bunch of price targets. It's not just Wall Street, of course. Newsletter writers have moved to their most optimistic bias in over a year as stock tickle to new highs. More than 3 out of every 4 writers expect stocks to continue to rise. Markets aren't usually so accommodating, with flat returns in the S&P 500 over the medium to long term. ETF traders once again see little need to hedge. Volume in inverse ETF, which benefit when the market falls, declined to less than 0.3% of all New York Stock Exchange volume. Since the beginning of 2013, a generally positive market environment, when inverse volume dropped this low, the S&P showed a positive return a little over a month later, only 13 out of 43 days. Bonds have been gappy. The TLT fund has seen a relatively large gap down, gap up, then gap down again over the past 3 days. This happened in mid-July and early November last year before even more selling pressure hit the fund. Over its history, such a pattern most consistently led to weakness over the very short term, with further selling over the next 2 days 14 out of 24 times. That was about it, with returns after that being in line with random. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:32 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 19th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, a bit of weakness, but nothing significant. All 4 of the U.S. broad-based indices are down just below scratch. Crude oil's up about 1%. Euro's down just below scratch. Long bonds down a little over 1/3%, and gold is down about 2/3%. In overseas action, it looks like everybody's open. China's down about 1/3%. Hong Kong's down about 1/4%. Japan's going the other way, up about 1%. And Germany is down just below scratch. And United Kingdom is down about 0.5%. In terms of macroeconomic reports for the United States for today of note, we have building permits, Philly Fed manufacturing, the weekly unemployment claims, housing starts, natural gas storage, and the weekly crude oil inventories, which has been shifted to Thursday this week due to the holiday on Monday. Fed Chair Yellen is speaking after the market closes. And then looking forward to tomorrow, we have FOMC member Harker speaking, as well as President-elect Trump. So let's see here. Let's go ahead and go to volatility. And our current volatility conditions, short-term VIX up to an 11.29, so a bit higher than we've seen of late, but still in relative terms very, very low. Skew still relatively elevated, 131.55. That's the second level of caution. No standard deviation size moves were put in yesterday on our close-to-close basis. IV percentiles, S&P of 14, the Russell at 18, the NASDAQ at 8, and the Dow a 17. So all very, very relatively low there as well. Let's go ahead and go over to the charts. And frankly, this is a kind of a repeat, and there's not much to say. We continue to be in this very, very compressed sideways range. Here's your S&P. And you see all the recent action is, very easily within about a 1.5% range. The Dow, a slight drift to the downside, but still very much within the context of the sideways range. The Russell, also that slight drift to the downside. We see a lot more action in the bottom half of the recent range than the top half, but yet at the same time, clearly in a sideways range. NASDAQ, of course, has been the exception, has broken up, but then in most recent trading sessions has been in that same sideways range. Then we have in other markets, crude oil. We've had a bit more volatility in crude oil, but still, if you go back, let's say go back a month, you're basically trading in the same area. So crude oil also, with a bit more volatility, has been sideways. And then gold. Gold, of course, has been pressing upwards and came right up into the cloud and then seemingly has retraced ever since it got up to the resistance area at the bottom of the cloud. And bonds has been the other recent mover, having not as strongly as gold, but certainly a bit of a pretty significant retracement up against a very weak prior pattern, and ran up against the bottom of the cloud and seemingly has fallen back from there as well. When we look at dollar, of course explains much of what's happening in crude, gold, bonds, and been a bit of weakness in the dollar of late against a very strong prior pattern. So we'll see as we come into this cloud area just where this goes. Expectations would be that that the dollar would start to strengthen and would make a run towards the former highs given its patterns. But we're about to come to the decision point for the dollar, and with that decision point will likely be the resolution of where does gold, bonds, and even equities go once they finally break out of their coiling patterns. So keep an eye on the dollar. And let's take a look at volatility. Volatility has had a little teeny uptick, but frankly, just from super low areas into normal kind of bull market ranges. Right now, our trading is in the low 12 handle. So, most of the time, anything between 12 and 15 we look at as essentially just noise, and we're even in the lower edge of that kind of normal bull band. Okay, I think that's probably enough in the charts. There just isn't much to get excited about on the charts these days. Now, obviously, with the inauguration, we could see the potential for increasing volatility as actual decisions instead of just rhetoric starts to come down, and that the effect of those various decisions on various industries and sectors and so forth start to actually be realized. In terms of the intermediate term phase opinion, we're market phase 5. We're been right on the edge of that where we broke the diagonal support on the S&P just barely, and one could argue that we even perhaps re-entered and that this flipped back to phase 3. So this is a very tenuous kind of warning right here, just kind of on the edge of warning status. In terms of the 3 market timing signals, they're all mechanical in nature. The first one, confirmed uptrend, still holds up from IBD GMI index, also bullish, with a 5 out of 6 signal and a buy signal that's been in place since 11:10. Stock charts decision point scoreboard, the third signal, still has the mixed signals in the short to long term, with the intermediate term being consistently to the bullish side. And indeed, overall consensus of these signals remains a slight bullish bias, but the expectation of a lot of sideways action until we get a stronger stack of the time frames on the stock charts decision point scoreboard. In terms of the position sizing opinions, both models coming in at 100%. Intermediate term market posture, we continue to see a little bit of degradation, but still within the context of the area of exceptionally strong bull. We do have the Russell with a weak bear, though we will note that this has been oscillating repeatedly between weak bear and strong bull in recent sessions. The hedge warning status currently 0+, normal with some elevated conditions. Strategy opinions, all three strategy opinions are within acceptable ranges to initiate new positions for novice traders. So the opinion does currently maintain a relatively conservative stand on the ratio of out of the money versus in the money strikes, and also the ratio of high beta versus low beta positions. And that's within the context of the fact that we're up against such an extreme high without any significant retracement of lately, and making it difficult to get too much out in front of the bull market. The bull market is just not that strong. We're not in a strongly trending bull market, so your cover call strategies are going to rein in some of that posture. In terms of specific areas of warning, most of this is about the very low volatility and the expectation that you could have an expansion. And we did have the volatility ratio warning indicator fire, though we've now just dribbled above a 12, so this one actually has come off. Distribution day count, a 6 on the NASDAQ, a 5 on the S&P. Skew remains just barely above 130, about a 10% probability of a 2 standard deviation move. So there's several minor, in the context of just how low the volatility is, several minor warnings coming in here, but nothing terribly exciting, especially within the context of a VIX in the 12 handle. In the trend-based area, of course, we still have this kind of tentative market phase 5. New highs, new lows, didn't really trigger either side. Now, we did have a change in intermarket risk aversion indicators. That one lone risk on has fallen back to risk off. So now all 5 of these are in the risk off status. So that's a bit of a warning area. Sentiment just above the neutral area. It's been oscillating in these numbers, 56, 58, and so forth, 57 in recent sessions. So not anything extreme by any measure there. Overall performance yesterday was just above scratch. And you see I say the heroes of the day. Well, financials were up, a little over 0.75%. Materials up about 0.2%. Pretty good breadth on those sectors. Industrials, consumer staples, information tech. So most of this risk-on kind of categories. And, healthy increases, but nothing terribly exciting. On the downside, you had healthcare, consumer discretionary, utilities, telecom, so all your kind of defensive sectors, but for the most part, barely down, and with kind of mixed breath. The 2 big telecoms were negative, and that was the worst sector at 0.76% on the negative. In terms of market postures by sector, you see for most of these sectors, the short to intermediate terms relatively weak. The exceptions are the consumer sectors, also utilities, materials, and technology are still holding up. percent change on recent action. Pretty choppy here all the way back through the 1 month, with a lot of sectors within a couple points plus or minus of scratch in the last 1 month time frame. Now, let's see here. Technology. Really, technology is the only thing that's made any significant progress, as defined as being more than 2% in the last month. Okay, that's probably enough. We're a little late getting started today, so let's go ahead and get this thing to publishing. I'm going to go ahead and scroll through these slides here. If you see something of interest, just hit the pause button. But I'm going to go ahead and get to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink at the bottom for the full set of disclosures. Manage that risk profile each and every day, and then also each and every day be sure to go out there and learn something about your craft. And we'll see you back here for the next session with Falcon Global with our market preview each morning. In the meantime, good trading.